Banks are stupid. In 2008, they crashed the entire financial system. Today, they are trying to hide roughly $500 billion in losses. This is why I never buy bank stocks. Banks rely on confidence. These losses only remain paper losses if depositors stay calm. But if confidence cracks, if customers start pulling cash like they did at Silicon Valley Bank in 2023, banks have to sell assets at a loss, and these hidden paper losses instantly become actual capital hits. And that is when solvency issues go from theory to reality. This is exactly what triggered the collapse of Silicon Valley Bank in March 2023. SVB held tens of billions of dollars in long-term bonds bought during the zero interest rate era. And when rates spiked, the value of those bonds plunged. Now, on paper, the losses looked manageable until depositors got spooked. They rushed in to pull out their money, and the bank had no choice but to sell these bonds at massive losses to raise cash, wiping out its capital base almost overnight. And in less than 48 hours, one of the largest banks in the country went from stable to insolvent. Why do they hold so many bonds then, if they're carrying this kind of risk? And part of that answer is regulation. After the 2008 financial crisis, rules were tightened to make sure banks always had a cushion of safe, liquid assets. Treasuries and mortgage-backed securities fit that requirement perfectly because they are backed by the U.S. government. They can be sold quickly if cash is needed. Now, equity markets already understand this formula. Today, bank stocks trade well below their stated book value, a sign that investors don't fully trust the balance sheets, as they shouldn't. But the lesson here is clear. Once confidence evaporates, accounting categories and regulatory labels no longer matter. What matters is whether depositors and markets believe a bank's assets are sound. If they don't, withdrawals accelerate, fire sales begin, and the liquidity crunch turns into a solvency crisis.